Breaking news. For the first time in years, there are more unemployed Americans than there are job openings. The JOLTS report just shocked the markets with only 7.18 million openings versus the expected 7.3 million, while unemployment now sits at 7.2 million. That means more people are out of work than there are jobs available. And that's not just bad for jobs headlines, it's a flashing warning light for the economy, for Wall Street, and for the Federal Reserve. And whenever the Fed gets concerned, history tells us Bitcoin is the asset that wins. What's up, family? It's Coach Massey, and you're locked into the Daily Hodl. This is where we cut through the noise and give you the Bitcoin and financial news that really matters. Quick reminder, this isn't financial advice. This is for education and information only. So always do your own research before making decisions with your money. All right, so now let's break down what today's JOLTS report means and why the U.S. economy is flashing warning signs, and also why Bitcoin is positioned to be the ultimate hedge as cracks start forming in the system. So, the Job Openings and Labor Turnover Survey, also known as JOLTS, came in at 7.18 million openings for the latest month. Economists expected 7.38 million. So that's a lot of jobs that missed. That's not just a small miss. It's a signal that the labor market is cooling faster than anticipated. But here's the kicker. There are now 7.2 million unemployed people in the U.S. For the first time in this cycle, unemployed workers outnumber the jobs available. Why this matters? Well, for 2 years, the Fed justified higher rates by turning to a tight labor market, and they argued that demand for workers was strong enough to handle higher borrowing costs, so they raised rates or didn't cut. In today's report, it shows the cushion is gone and that the labor market has flipped from strength to weakness. That changes everything about the Fed, and we'll see how they will react this September. Let's break down what the shift actually means for the U.S. economy, though. Consumer spending is at risk. When fewer people can find jobs, confidence drops. People cut back on spending, and since consumer spending is roughly 70% of the U.S. GDP, this is a direct threat to growth. With weaker demand, companies face lower revenues. And if you're in the market, slower earnings mean Wall Street has to revise forecasts downward. That creates volatility in stocks. The Fed has been walking a tightrope for the last couple years to keep rates high, to fight inflation, but not so high as to crush jobs, while they're finally maybe at a breaking point. Today's JOLTS miss shows that employment is now wobbling. If job losses accelerate, the Fed's soft landing narrative is officially dead. So, here's where it gets real interesting. When jobs get weakened, central banks historically panic. 2008, financial crisis, mass layoffs. Fed slashed rates to zero and it went to QE. In 2020, pandemic shutdown, unemployment spiked, and trillions were injected into the market. And every time, stimulus and money printing followed. This pattern is simple. Weak jobs equals a Fed pivot, which equals liquidity injection, and hard assets rally. So let's talk why Bitcoin cares. Let's zoom into Bitcoin. It's a liquidity frontrunner. Bitcoin is the ultimate liquidity play. When money floods into the system, Bitcoin is usually the first asset to sharply move higher. In 2020, when trillions hit the market, Bitcoin ran from 8,000 to 64,000 in just over a year. When unemployment rates rise and money printing ramps, the US dollar loses purchasing power. Dirty fiat is what you don't want. See, Bitcoin, with its hard cap of 21 million coins, becomes the alternative that can't be debased. So every jobs miss erodes confidence in the strong U.S. economy worldwide, globally. As trust in central banks declines, Bitcoin's trustless, decentralized model becomes more appealing to both retail and institutions. You see, gold is already inching higher as investors hedge against risk. But here's the important historical stat. Bitcoin tends to lag 30 days behind gold. If gold is rising now, on this week's labor data, imagine Bitcoin could follow in September and early October. The setup looks eerily similar to past cycles. Gold breaks out first, then Bitcoin catches fire. And that's why you're here. Expect mainstream outlets to downplay this, and they'll say it's just one report, the labor market is still healthy overall, but markets trade on forward expectations, and the JOLTS miss this morning changes expectations in a big way. So, Traders and institutions will start pricing in earlier Fed cuts. And that's bullish for Bitcoin because rate cuts equal liquidity. Liquidity equals risk on, and risk on equals Bitcoin pump. So let's connect the dots together. The JOLTS report equaled more unemployed jobs, or more unemployed than there are jobs. Weak jobs equals slower growth and a weaker economy, and a weaker economy equals a Fed pivot. And Fed pivots equal money printing and liquidity gets eaten up by Bitcoin. And that's the chain reaction that happens. It's the historical playbook. All right, family, I want to hear from you. Do you think this JOLTS miss is the turning point that forces the Fed to pivot sooner than expected? And if unemployment keeps rising, does Bitcoin become the number one safe haven, even above gold? Well, drop your thoughts in the comments below. Don't forget to hit the like button, subscribe if you're new, and share this with someone who needs to understand why Bitcoin isn't just another asset. It's the hedge against the entire broken system. That's your daily hodl. Stay sharp, stay disciplined, and as always, lead, pray, hodl. I'll see you in the next one.